Usually I do 2 videos. I try to anyways. 2 on Saturday, 2 on Sunday, and then 3 Monday through Friday. It's just the amount of stuff I have to do these days as far as the news. I want to do these videos, keep people informed with what the hell's going on. It's like rapid fire as each year goes by. Never in my life thought I'd be doing 3 videos a day, like ever. Never thought I'd get to even 2 videos a day. Now I'm at 3 videos a day, 2 on the weekend, when I could literally do 3 all day, every day, if I really wanted to. And I felt like because of this news, I really appreciate this news. I'm doing an extra video on Sunday. Okay? You're going to like this one. silverdoctors.com or SD Bullion. Breaking. Appeals court overturns dismissal in JP Morgan silver rigging case. So first, the court decided you got nothing, throwing the case out. Now, the Court of Appeals has said, well, no, there is something here. And the original judge should have thrown this out because really he didn't have a reason to. But was that judge part of the club? Most likely. So this may be the biggest event in the silver market in decades. Why? Because next comes what they call discovery and fact-finding. Submitted by Vincent Lancy. U.S. Appeals Court overturns dismissal in silver rigging case against J.P. Morgan. The appeals court rejected Judge Engelmeyer's claim that the plaintiffs did not prove J.P. Morgan made uneconomic bids in the silver forwards markets. New discovery may win the case but against J.P. Morgan. This is a summary. The New York Second U.S. Circuit Court of Appeals ruled, which it said yesterday, but this was more like 2 days ago. Yesterday that the district court judge Engelmeyer was in error when he dismissed the silver price rigging lawsuits against J.P. Morgan. The appellate court felt that Engelmeyer's dismissal reasons amounted to impermissible fact-finding and placed too high of a bar in conducting that plaintiffs had not adequately pled their case. This reversal of the June 2016 dismissal means the case will go back to the district court for further litigation. This also means that the plaintiffs will ask for and receive more discovery, and this could win the case for them. So the lawsuit was dismissed in June 2016. JP Morgan Chase & Co. had won the dismissal of 3 private antitrust lawsuits, including from hedge fund manager Daniel Schock, accusing the largest U.S. bank of rigging a market for silver futures contracts traded on COMEX. The lawsuits accused J.P. Morgan of having, in late 2010 and early 2011, placed artificial bids onto the trading floor, harangued employees at metals market COMEX to obtain prices it wanted, and made misrepresentations to a committee that set settlement prices. Our report, June 30th, 2016, J.P. Morgan Silver decision flawed. Why it was dismissed in June. U.S. District Judge Paul Engelmeyer in Manhattan, you mean like New York where the club is? Yes, of course. However, said that the plaintiffs, who also included traders Mark Grummet and Thomas Wacker, did not show that J.P. Morgan made uneconomic bids or intended to rig the market at counterparty's expense. He also questioned the plaintiff's use of silver indicative forward mid-rates, or SIFO or SIFO, as a benchmark for determining proper levels for the spreads in their lawsuits. In fact, on April 21st, 2016, J.P. Morgan urged the judge quash the litigation. J.P. Morgan insisted allegations that the bank monopolized the market were too vague to support antitrust claims. They urged the judge to raise the bar for the plaintiff's burden of proof. We need you. Let me repeat. We need you badly to raise the bar on this one. The appeals court, however, overturned the dismissal a couple days ago. And the appellate court held that the plaintiffs did, in fact, submit evidence that did, in fact, reach a level warranting further investigation, Therefore, the case should not have been dismissed. In quoting the law, the three judges stated, "A plaintiff need only allege enough facts to raise a right to relief above the speculative level and state a claim to relief that is plausible on its face." They stated that Judge Engelmeyer's requirements for such specifics were too high to reach, describing the proof bar being raised to a level of detail not required to withstand a motion to dismiss. In essence, what Judge Engelmeyer asked of the plaintiffs was impossible to ascertain in those proceedings. Specifically, fact-specific questions cannot be resolved on the pleadings. So, can J.P. Morgan monopolize silver? Yes. The appellate court noted that the plaintiff's allegation of J.P. Morgan's ability to control silver futures prices with reference to a particular market was proven correct. Thus, the district court did not err in concluding that the plaintiffs plausibly alleged a relevant market. This means that the plaintiffs showed plausibility that J.P. Morgan could control the far end of the silver futures term structure via non-competitive bids. To traders, that means the J.P. Morgan client who had to sell back month was faded way too low. Edit. And when one looks at the term structure from then, it is obvious that no true physical demand was in evidence based on the spot contago. Did J.P. Morgan monopolize silver? To be determined. The appeals court did not say they believed J.P. Morgan exercised such ability to monopolize the silver market, but the statement that they noted the power to do so was proven in the first hearing is significant in that it agrees with the district court's findings. So what's next? The appellate court says the plaintiffs made a sufficient enough case for further investigation into a monopoly claim. So that was 1. 2, the findings of the appellate court will accompany the case file. 3, Judge Engelmeyer's decision is removed and the case is remanded for further litigation and discovery. Market Slant's analysis post the decision in June 2016 that SIFO, the SIFO is key. Given the lawsuit's failure both to explain why SIFO should track silver future spreads and to concretely plead that it did so consistently, a mere general correlation between these two is not sufficient to make SIFO a reliable benchmark such that deviations from it support a claim of irrational pricing animated by anti-competitive aims, Engelmeyer wrote. Analysis. A poor job was done explaining the role of SIFO in spread pricing. SIFO represents the spread between expirations of forward physical contracts in silver. The futures spread markets are derivative of the SIFO spreads. SIFO represents the cost of carry for physical silver and is used in determining lease/borrow rates over periods of time. These are in turn extrapolated and the dominant factor in determining futures spreads on COMEX. COMEX spreads are a direct function of SIFO. Without SIFO, there are no spreads. And since SIFO was a much bigger market than the COMEX spread market, the pricing mechanism was not fully transparent. It was in the hands of a few dominant cartel-like players, as it had been for the last 30 years. Analysis. The demand was fabricated. The market was only partially backwardated. Spot was below the next 6 expirations. Translation. There was no massive demand for immediate delivery. There was only demand in months that were the last remaining floor traders who took risk trading their own money had positions. J.P. Morgan's own book was likely short and had to get liquidity to cover their own positions. We knew Mr. Shack from our floor days and were trading spreads off floor when this happened. They should not have lost this case. COMEX traders do not trade spot. Spot was under the backwardation. Smoking gun? No, but damning circumstantial evidence in the least. Bottom line on the trade. What really happened then was a silver miner had to hedge forward and cover up front. J.P. Morgan likely had this client cornered and faded their back month bids. The miner, having nowhere else to go that he could go, hit them over the counter, OTC, when they were much better bid on the floor. Once SIFO and COMEX spreads are proven to be linked, the case will be made. Remember Blythe Masters? Blythe did a mini buffet, or was that Buffett? Like Warren Buffett to a client. Not a buffet, Mr. Buffett. How come in 1997, when Warren Buffett, who actually stood for delivery, the market did not rally until after the spreads backwardated all the way to spot? Yet in 2011, the market had rallied already, and all of the sudden spreads, literally overnight during Asian and London hours, went into backwardation. In a real market, the spread activity predicts the physical demand before the flat price does. You see the spot price start to act squirrely to the front month future of in the EFP. There are expectations to this, but there are exceptions to this, but it is rare. This trader also remembers that in 1997, Mr. Buffett was asked by the government to defer his request for delivery for a year. He happily complied by selling spot and rolling out to a 1-year future. Payout? He netted an ROR of 40% due to the negative carry without selling. Effectively, he lent the producers their silver back to them, $7.40, at a premium of approximately 40% higher than his cost, which was $4.50. So Blythe did a mini Buffett, that's all. Why wasn't that opportunity afforded Mr. Shack and other locals? Does that have to be answered beyond this? In Mr. Buffett's case, the integrity of the market was at stake. Hunt Brothers, anyone? The whole silver mining industry was in jeopardy. Too big to fail. But in Shack versus JP Morgan, only locals got burned. I'm sure each one of my arguments for manipulation can be taken apart by some lawyer or expert, but that is what they do. Facts against them? Argue the law. Law against them? Argue the facts. Both against them? Use ad hominem attacks to shoot the messenger. But for now, it's fair to say, based on information and evidence, we believe the silver spread market was rigged, Your Honor. And the appeals court indeed agreed that there was enough evidence to look further into this. Next comes the discovery and fact-finding. The sad part is government is 20 years late. The U.S. citizen has already been sheared for a generation, losing billions. Banks have moved on to greener pastures. It is now safe to prosecute U.S. buggy whip makers, to mix a metaphor. So I'm always and have been of the opinion nothing happens by chance. Timing is everything. And when it's time to let something happen, they let it happen. This is an appeals court, whatever. This is taking place in New York, Manhattan. Is it time that the club understands, let's go ahead and move forward with this. Let's let it go. Let's let it get out. This is part of the collapse plan. Right? Like big squares like to say, the road to Ruta theory, where crap's going to hit the fan, but only when they let it hit the fan. And I'm going to end this video reminding you once again, November 2014, the Chicago Mercantile Exchange, which runs essentially the COMEX market that we're talking about here, added 2 rules that had never been done before. Circuit breakers for gold and silver. Why would they allow circuit breakers to save your butt? They don't want to save your butt, like I said. They want you to get crushed so that you never stick your neck out or your hand out and ever get into the silvers or gold's futures contracts game ever again. Ever. Crush them. Crush the cockroach. They wouldn't want circuit breakers triggering as they're trying to crush you so that you could possibly get out of your trade. They did that for the same reason I've been saying it since they did it. I still stand by it. They did that so that when the prices, like what this could uncover, and the prices finally have to be let go, they're going to explode. They must cap, to the best of their ability, that explosion upwards. How do they do that? Circuit breakers. No more trading for the next 15 minutes. Okay. All right. Trade again. Oh, another circuit breaker. It can only happen 4 times. apparently in a day. After that, it's game over. It can go as high as it goes. Now, just an FYI, for silver, it's essentially a $3 move in a certain window of time. Okay? That's circuit breaker 1, another $3, circuit breaker 2, and so on until it's a total of $12, you could say. Not exactly like that, but just bear with me. So I think Webbot said there'd be $5 day moves and $20 day moves. Correct. There could be a $5 move. For example, silver opens up today at $18, okay? And it moves up not too rapidly past that $3 move, which would normally trigger a circuit breaker. It did it in a period of time that maybe throughout the day it was up $1, it was up $1.50, $2, $3, but it never met the criteria for the circuit breaker to trigger. Therefore, oh wow, it started at 18 and ended at 23 or 22 or whatever, right? Well, $5 would be $23. So there's your $5 move. But it also said, absurd as it is, absurd as it may sound, $20 moves after you see those happening. So how the hell are we going to get to a $20 move when we got $12 of circuit breaker-ness? I can only say that the circuit breakers, all 4 of them, are hit very rapidly. The day is not over yet, but all 4 have been triggered. Now there's no mechanism that will trigger. It's good night, good day, where's this thing going to go? And the next thing you know, oh my God, it ended $25 or 20, whatever, $20 higher. So that's all I got for you. Just, I know it sounds crazy. Webbot talked about this, but does it sound a little bit less crazy knowing that the CME group, the club, put these circuit breakers in place in November of 2014 when for the last 30 plus years, nothing of the such was in place. When they crushed you at $49 silver and smashed it down to 40 to 35 to 30, did any circuit breakers kick in and, stop that from happening? Absolutely not. What did the CME group do? We're raising margin requirements. So anyone that has an open contract, Monday morning, it's Friday night, Friday evening, Monday morning, you need to be in compliance. So either A, sell off your contract, or B, add more money to your account. We need more margin in there, more maintenance fee. Knowing that nobody's going to do that, everyone realizes we have no other choice but to sell. And that's what pushed the market down each and every time. I remember doing videos when this was happening saying, wait a minute, they just changed the margin requirement and caused a sell-off. 2 days went by, they did it again. This is criminal. They did criminal activity doing that. Never have they done anything like that before. But that's the only way they could smash that baby down on us. Get away from that because the markets were on fire. Massive volume was happening. They didn't want anyone getting these futures contracts. Even though people didn't want to demand delivery, that's all right. We'll write it up on the leverage margin. Nope. We want to crush you on the way down. So I am an absolute firm believer we will for sure see $5 day moves and followed by those big 20 plus moves. So just wait until we see the first $5 move. I'm going to be here in your face like I am every day, but I think I'll put my face closer to the camera just for a little emphasis added. You know what I mean? A little special effect. Like Webbot said so a long, long, long time ago. I've been ridiculed for repeating it. It has been ridiculed massively, Cliff High, really. And here it is. Once and for all, it's in your face. I'm telling you that day is coming. This is good news. Take care.